I'm Brett Goodyer. I'm from Business Valuations Online, and we do exactly what it says on the box. We value businesses and we do it online. We do it all over Australia, and we have valued over 600 businesses in the last year and a half.
Tell us what basic elements you would use in valuing an accounting practice.
An accounting practice is not really any different to any other business. Business valuations are made up of two core aspects, and that is the risk and the reward. We would be looking at how profitable a business is and its specific risks, whether that be its geographic location, its specific makeup of clients within its book, or various other aspects, even the use of technology within that business.
And there's a difference between actually buying the business and buying a book of clients, isn't there?
There certainly is. So buying a business would imply that you are taking over the business in situ. It is the business as it's currently running, and you're stepping in and essentially taking over. Whereas buying a book of clients is essentially relocating a book of individual clients to a separate practice. And the valuation methodology is usually quite different. A methodology that has really evolved over many, many years, and it becomes known as an industry rule of thumb. And that is often 1 or 1.2 times revenue, for instance. And that is completely different based upon how that client book is made up.
So is it mostly based on revenue or based on net profit?
Well, it is based on revenue if you are purchasing a book of clients, and profit if you're buying the business.
I see.
And so if you're buying a book of clients, what you'd be looking at is the type of client that they might have. For instance, you'd be looking at, are they individual income tax returns, or is it a suite of business clients that are on a direct debit? They are valued very differently because one is much more risky and more likely to be not recurrent revenue. And that's what we're really looking for. How recurrent is that revenue and how relocatable is it?
What's the difference between a small business that's, say, $500,000 revenue and one that's $5 million revenue?
If we're talking about either the business or the suite of clients, it's going to be a fairly similar answer. The size of that book or the size of that business is actually going to reduce its risk profile, and therefore it increases the multiple and increases the valuation.
What sort of multiple would you start with a $500,000?
Ordinarily, if it was a valuation of the business, we'd be looking at probably no more than 2 times the actual profit of the business. Whereas if we're looking at a book of clients, you'd probably be starting at around 0.8, so 80 cents in the dollar on revenue. Big disclaimer on that, it really needs to be assessed on a case-by-case basis. You can't just arbitrarily throw a different multiple at each individual book of clients. We're completely unbiased. We've got nothing to gain or lose by providing a valuation to our clients. We provide a completely independent, arm's length valuation.